and the banks give you a lower interest rate because of it, but the insurance premium actually gets added in. So that's how we buy homes with less than 20%.
Hey everyone, today I was able to catch up with Lorne Andrews again, and we talked about a few things related to the real estate market. We talked about the interest rates, the current state of the market, the elephant in the room, the down payment dilemma. But we didn't just talk about the dilemma, we talked about a potential solution. And Lorne was able to walk us through a scenario in terms of how a shared equity program may be a solution or a strategy that you may want to think about. Here's the interview. Catch us up on what's been happening from the lending side of things, and give us some insights into what's happening now and what we can think about or what we can expect in the next few months to the end of the year.
Amazing. Thanks, Nicole, for having me back. It's always nice to see you. Right. So, yeah, it's been, I think the spring market's here. What do you think?
I think that you are correct. I think based on some activity I've been seeing, it's maybe the market is kind of trending from balanced, where a little bit earlier in the year you could have negotiated a little bit more, but now I'm seeing some competition creeping in, not like it was a few years back or even last year. Maybe 3 to 6 offers I see coming on properties that are really in desirable areas.
Yeah, I think it comes down to, in terms of from a real estate perspective, is pricing things correctly as well, right? It comes down to that as well. And when things are priced correctly and the demand is there, it's obviously going to translate to maybe multiple interest in that particular property. And I really think that's, so what I've seen in terms of, because I still get, people that have been on the fence.
Yes.
And there's a few reasons why they're on the fence. And one is because they're maybe waiting for interest rates to drop, for example. Okay, so interest rates are high, right? So they're going to be dropping. They say they're going to be dropping. We're going to be waiting till they drop. So what happens when we wait till interest rates drop?
Prices are going to go up. Competition is going to heat up again.
Yeah. Like that's the problem, because as soon as they start dropping, people start flooding the market, because you would know on your side, when you look at inventory levels, they're still not high, are they?
No, it's pretty low. Pretty low.
It's pretty low. So and we can't increase inventory overnight, because we know that's probably the major cause of where pricing has gone, is because inventory has been low, and the demand and the influx of from immigration to just buyers trying to get out of the rental market into homes as well. We were just not able to meet that demand, and sure, it slowed down because interest rates went up, right? And people were waiting, right? And I had somebody ask, I talked to somebody not so long ago, maybe a couple of weeks ago, and they said, no, we want to wait till interest rates get down to where they did back during COVID, right?
And that's what I'm hearing too. Hearing a lot of that. Yeah.
Unfortunately, and I don't control where interest rates are. None of us has that control, but the government has been pretty clear in saying, oops, we made a mistake by putting rates down so low and keeping them down there so long. Because I think what happened during that time, it became like the new norm, right? It was, I can get 1.99% on my mortgage. And when rates were down to, around 3.5%, I was at a conference in the US talking to some mortgage brokers, and I was asking them where their rates are. And they were like, "Oh my God, they are so low. We're so super busy. Everybody's so excited. They're about 5.25, 5.5%." And I was thinking, man, if we had those type of rates in Canada, they would it would slow down the market. People would say, "Oh man, these rates are too high." So it's perspective because that's what they were used to, right?
Right, right.
And I think where rates are going to come down to. So I mean, we now have rates below 5%, which is a good sign, right?
Hmm.
Rates that
Hmm.
uh, a month ago were close to 6% have come down to close to 5%, and some below 5%, right? Which is great. But I think the new landing spot that you're going to see where rates are going to go is, between 4% and 4.5%, maybe for 5-year terms, right? That's
Right.
probably where we're going to land. So we're not that far off, actually, right?
Exactly.
And I think with one of the issues too, you hear in the news, rates are holding, they haven't lowered the rates, and they may lower it in June, but they're really talking about prime, and that
Prime.
really affects our variables. And they don't mention that fixed rates have come down a whole percent, almost over the last, 2 months, which is significant. And maybe if they did, everybody would be running to buy those houses, and then it would cause another problem, right? Um, so, so when do you think the best time to buy is?
To me, the best time to buy is when you can afford it. So affordability needs to be kind of the most important thing you need to look at. Yes, rates can be high or can be low. I think if you look from a historical perspective,
Mhm.
rates that we have right now are actually quite low or average, based on the past 30, 40 years. We've seen rates as high as in the teens and low 20s, in the 80s. So I mean, and everybody said, oh, we're never going to be able to afford a house at these rates. So I think, as you said, it's context. It's looking at things in the appropriate context and the appropriate lens. But definitely it's affordability. I think that's the key criteria, is when you are able to afford something. um Kind of, yes, the interest rates are maybe a little bit higher now, but interest rates change over time. Whereas when you're buying or you're purchasing that property, you're either purchasing at a reasonable rate, which you can probably get now, or you're going to be in a position where that competition is intense and you really want to get the property, and you might be paying a little bit more in order to secure that property. So it's a trade-off, but I think affordability is the key factor that you need to think about.
Yeah, for sure. And I think what's different from that comparison you said, where rates were higher,
Hmm.
and even where rates are right now in comparison and trending downwards. What we didn't have before was a stress test, right? And a stress test is basically what the government implemented to say, I don't care what rate you're going to get, but you're going to qualify at whatever that rate is, plus 2%, because we want to make sure if rates increase, you're going to qualify. And so now we're using 2% above the rate, which is increasing, not the payment you would be making, but the payment we have to qualify you at a higher amount, which decreases the amount you qualify for. So I think that's been part of the difference maker in maybe slowing down people's, where people could qualify for a certain amount, which, before the stress test could be, considerably higher than it is today because of this stress test that the government put in.
So let me maybe make one comment on the stress test, because I know it might be an angst, something that causes a lot of angst. However, I think if you look back in hindsight over the last few years, it's probably helped in the sense that people didn't get into properties that where they would be feeling angst right now with renewing their interest rates. So yes, it's something that's a check that's put in there to make sure that you can afford the property. But it's also, in hindsight, if rates increase like they did, and it wasn't anticipated, you're not having a lot of people who are having, stress from financial issues and potentially having to, be forced out of their homes that they invested in.
Yeah, I agree. You know what? When it came out the first time, we're always like, oh, why are they doing this? Doesn't make sense,
Hmm.
because we were always used to rates being wherever they were, and there was never
Hmm.
that drastic swing that we ever saw. And when it did come down, and then people were saying, wow, now I can buy this, I can buy an investment property, I'm going to go to a variable, and that's the lowest rate possible, not thinking that with it, with what inflation did, and well, inflation didn't do anything, but the government changed the rates to try and fight the inflation.
Hmm.
The impact that it would have on those mortgage payments, and it's put a significant stress on many people that were in those particular situations.
Hmm.
There's two types of variable: is rate adjustable or variable, and they sometimes get mixed up. But there's the ones that if a rate changes, your payment will change with it.
Hmm.
And there's one, if the rate changes, your payment doesn't change. This is the proportion that goes towards the interest and the portion that goes towards the principal that adjusts. And what was happening when the rates were starting to go and go and go, and they weren't changing this payment, then people started to have a negative amortization. So it was, instead of having 25 years left on the mortgage, all of a sudden they had 35, 38, 40 years, that type of thing. So they had to do some lump sum payments to catch up so they can get back to, the regular scheduled amortization, right? The amount of time they're going to pay off
Right.
that mortgage. Um, so you're right. Like, it was put in for a reason, right? And it definitely created that buffer, right? Which helped in many ways. So that's, I mean, and that's, I think part of that's one part of it, but then
Hmm.
the other part, Nicole, is people, for home buyers trying to get into the market right now, um, housing prices in the GTA, right? So I mean, where would you say, from the last, even the last 1, 2, 3 years, where would you say house prices have gone to from in the GTA?
Oh, I just recently did an analysis. It has ranged. I've seen even up to 39%, depending on the type of property. So from, say, I think my assessment was from October 2020, when, we had a solution to COVID, to end of January. I've seen condos, condo townhome, freehold townhome, semi-detached, detached. It varies up to 39%. So some areas it was 1% minus 1%, but the majority it's in the teens. It has been an average
Yeah.
increase in prices over that period of time.
Yeah. And that's been because especially in, I think, 2021, 2022, there was a big jump, and
Yes.
then there was an adjustment after rates started to change and everything else, but still now going up still continuing an upwards trend, right? So what do we say for those clients that are they're trying to save, right? They're looking to try and get into a home. They're working on trying to have a down payment, because not only house prices, like what happened with rents?
They also went up because of that, the pressure, the demand. And then when people
Yeah.
decided to stay on the sidelines, they needed to stay in their rentals. And as you mentioned earlier, immigration, we are having more people come into the country. At least 500,000 PR, permanent residents, not even non-permanent residents, coming in needing housing in this area. And GTA is one of the key areas that everybody wants to come and live.
Yeah.
So,
And that has, so you have a influx of people that are taking up the rental inventory, so it's pushing up rents, and then
mhm,
people are going, oh my god, I could pay for a mortgage for what I'm paying for this rent.
right.
So now I say, okay, I have to, but now you're trying to pay rent every month and trying to save for that down payment, and it's tough, right? And then
Hmm.
you got your okay, and let's say you got your eyes set on this home that's maybe, say, 600,000. Okay.
Right. Hmm.
um and I assume there's homes out there for 600,000, right?
That's
I,
yeah.
you would know, right? I don't know where they
Condo,
are, but
condo, condo.
yeah, it's
Depending on
condos.
where,
Okay, great.
depending on where you are. Yeah.
It depends on where. Okay, so
Hmm.
700, whatever that amount is. Okay, so then you think, okay, that's the home I want. let me let me save for an extra year, and then then I can go buy that $600,000 home, right?
Not not
Well,
really.
not really, because that $600,000 home isn't $600,000 anymore. Now it's
Exactly.
720,000, right? So by not getting into a home sooner, I'm always losing. I'm losing ground. I'm losing traction. I'm losing equity. I'm losing. It's. I'm always behind, and that's what I find, which is I know that there's people out there that are listening. They're a little disheartened over the chase in real estate because it seems they're always chasing the market, um, and and that's where it's interesting because as a mortgage broker, we're solution specialists. We're thinking, what we do is we look at everybody's situation and say, okay, we're going to get you into a home, and we're going to navigate to figure out how we're going to do that and to come up with a strategy to do it. And the great thing now is there's so many new programs that have come into play that are going to bridge, the opportunity, going to make that what seemed so far away, in terms of where they thought they would get into the home, then all of a sudden, wait, there's now new programs that we can actually tap into and maybe get you into a home within the next 6 months, maybe sometimes. We just had one that was like 2 months. They thought it was going to be years. Within 2 months, they bought a $1 million home. They had a good income. They just didn't have down payment. So there was down payment assistance programs that we kicked in.
And that's the thing. I think the down payment is the critical factor right now, that a lot of people are facing, is having enough money to put down on the property. So, just as you mentioned that, can you maybe give us a little bit more on one of these programs that's out there and how they can help, how you can get people into a home using one of these programs?
Yeah. Okay. So let's okay. We'll take a step back because I don't know like who's watching. Some people might be brand new. They don't know what you need for a down payment. That sort of thing. So generally, if you're making a purchase of a property, okay, and let's assume the property is under $1 million. Okay. So and I know there's properties out there under a
There
million
are.
dollars.
There are.
So there's lots of them. There's lots of them. So basically, your minimum down payment that you have to come up with is 5% of the purchase price up to 500,000. Okay, so the portion that's over the 500,000 up to $1 million, you need 10% of that portion. Okay, so it basically means if I'm buying a $600,000 home, I need a minimum of $35,000. So 5% of the first 500, then 10% of the 100,000, 35,000, and plus closing costs. But we'll
Right.
keep closing costs off up to the side, right?
Hmm.
So I know that's my minimum. Okay. But I also know that, so to qualify for a mortgage, really the formula, if I don't have any other debts, is usually about approximately four
Hmm.
times
Hmm.
your income. Okay. So four times the income. So if I have a combined income of 100,000, multiply it by four, that's $400,000 mortgage. And then add in a down payment on top of that, then that gets you close to where your purchase price is. Right. So now, and then the restriction on that is on the financing side, it's an insured mortgage. So any mortgages that you're putting less than 20% down, there's a mandatory insurance through CMHC or Sagan or Canada Guarantee that has to be placed on that mortgage. Now, you don't have to pay this insurance. The bank is so kind to pay it on your behalf, but they'll just put that balance into your mortgage. So it ends up being an extra $20 or $30 per month, that sort of thing. But that insurance is designed to protect the banks. That's really what it is. And when the banks give you a lower interest rate because of it, but the insurance premium actually gets added in. So that's how we buy homes with less than 20%.
Hmm.
Okay. But if we have the difference here between affordability, if you had a full 20%, okay, 20% down payment, which you need a 20% down payment to buy anything over $1 million. There's no exceptions. You need a 20% down payment. But if you had a full 20%, what happens when we do this is there's no longer that CMHC insurance, right? So we get rid of that.
Right.
Now we can you do a 30-year amortization on your mortgage, which basically drops the payments, increases what you qualify for. So you can qualify for a higher mortgage. Okay. Add on a 20% down payment on top of it. Now you have now you're at a different purchasing. Your purchasing power is increased, right? So
Mm-hmm. Mm-hmm.
so the difference it would make, let's say, for example, we're dealing with, if you had a combined income of say 130,000, and maybe at that particular point, you're qualifying for, let's say 600,000. That's maybe what it is. I don't have the exact figures in front of me, probably about 600,000. You have a 20% down payment. You can actually purchase for about 800,000. Okay. So it will increase by having that 20% down payment. It can increase. It'll start incrementally, even be more than that, but it's maybe about $200,000 more that you could afford in terms of buying that home than if you had
Right.
less. Okay. So what happens, you got a lot of people on the sidelines saying, you know what, the type of home that I can afford right now, it's just not going to fit for my family. So
Right.
I have to wait and save because I don't have bank of mom and dad. I don't have a family that can give me a gift to help me that down payment. I have less than 20%. So going back, that's the backstory. But now so this new program that's come out it's a company called Arboro. All right. And I think they were a bunch of people that were in the basement saying, how can we make home ownership more affordable for people like us to get out of our parents'
Exactly.
basement? So they developed this whole program, which is basically gives whatever you need to have a full 20% down payment, right? So you just have to have at least 5%. And with this program, you can actually buy up to $1.6 million
Uh-huh.
with just 5% down. They'll give you whatever you need to have that full 20% down. Okay. So having the 20% down just does everything I just said, eliminates that CMHC, increases your purchasing power. And, if you had a combined income, let's say you had a combined
Mm-hmm.
income of 200,000, okay, with less than 20% down, your maximum purchase price is 860,000. And with 20% down with this program, I'm at 1.1 million,
Right.
right?
Right.
So it's definitely changing, how much you qualify for. And then there's many properties that are priced over $1 million. And there's people that could afford a mortgage for that home. It's not an issue,
Right.
but they just don't have that full 20% down payment,
Exactly.
right? So you can use this program now to get into those homes today. Because we talked about that home. If you didn't buy that home today, but you bought it, $1 million home today, if the market appreciates 7% per year, which is reasonable from the numbers you were talking
Right.
about, you were talking about 12. Let's say we
It's a
lower it to
7. Let's do,
7,
yeah,
right?
exactly. Average.
Let's do
Mm-hmm.
7. And let's say it's going to take, let's say I'm renting, I'm paying $3,500 a month for the house I'm renting, and I'm trying to save on top of that. And maybe I'm even doubling that. And even if I had $100,000 saved
Mm-hmm.
already, to save that extra 100,000 to buy the $1 million property, it would take me over 5 years. And in 5 years from now, if that house appreciates at 7%, it's now 1.4 million. I just lost $400,000 of equity by waiting to try and get into that home. And then now I don't need I'll start off with an $800,000 mortgage on a million, but now I got to start off with a $1.2 million mortgage on,
Yes.
1.4. Like, it's just crazy, right? So if we can help people, Nicole, if we can help people get into a home today with all these different programs, look, there's one of
Many.
many other
Yes. Yes.
programs, right? Because a lot of people just don't know about it,
Right.
right?
And so, okay, so I wanted to ask you, what are you seeing? So, I really love that overview in terms of that program, but what are you seeing on the ground in terms of how you're helping people, how people are using it, when they learn about it? What are you seeing?
So that's a great question, because actually from the conversations, just knowing it exists,
Mm-hmm.
we're getting a lot of calls, right?
Yes.
We're now we get people coming in, but the big thing for us is making sure, like, we are home loan strategists. We're solution specialists. We help
Right.
people navigate the proper way. So a lot of times when people will call us, because so I should preface this. So this particular program is down payment assistance, is also called shared equity, right?
Yes.
So
Mm-hmm.
basically there's going to be an equity share. You don't have to pay them any payments per month or anything else. There's no loan payments. They're not even on title. It's just, hey, listen, when you sell the home later on down the road, you're going to pay us our shared equity portion based on what our down payment was, right? So you're going to pay them when you sell that home. But what it does is allows you to build equity in a home with based on what you put down as well. And
Hmm.
then maybe 4 or 5 years, sell that home, cash out your equity, go buy your other home, because you're leveraging real estate and the growth of real estate to build your wealth, to allow you the opportunity to get into that next home, right?
Right.
And
Yeah.
then so yeah, and when we get these inquiries that come in, there might be, over half of them that we can say, you know what, there might be another solution based on their scenario, right?
Hmm. Hmm.
It doesn't have to be this program works for some people and works for other people. There might be a better solution for. So it's just really understanding, listen, where you are, what resources you have around you, we need to get you to, and then figure out what's the best route to do that. And because these programs, they're not they're available, well, not available everywhere, but they're available in certain areas.
Yeah.
Um, but might not be perfect for everybody. It's just everybody's different. Um,
Exactly.
and
But
and I
it's
think that's the other,
awareness. It's
yeah,
making sure
awareness.
people know that this exists and there's hope out there. Do you know what I mean? Because some people are just on the cusp and they think, oh, let me just put this aside because I can't do it. But there are programs out there that can help um, get you into a home sooner.
Yeah, 100%. And I think you're so good with your clients because you have a holistic approach to your relationship, right?
Hmm.
It's about them. It's about helping their family, but not just now, but down the road. It's about aligning their goals, right, and
Hmm.
making sure
Hmm.
that you have their short-term goals and their long-term goals. You know, um, I guess a good understanding of what they are, so you can help them properly, right? Um, and it's funny because I was at one of our realtors that I knew. They were doing a open house, and they had those flyers, and they said, "Hey, listen, when you come in, there's a program that helps people with down payment. If you know anybody, please grab one of those flyers to them." And they were looking at it, and they were all angry. They had anger in their eyes. And the agent's like, "Are you guys okay?" And they said, "Why didn't my agent tell me about this?" Right. So the fact that you do so much in terms of making sure that you're so aware of, what opportunities there are for buyers out there. Like, I commend you for that, because not every agent is like that. Right. So you
Hmm.
do a very
Okay.
good job for
Thanks.
your people.
Appreciate that. Thank you. Well, I love strategy, and strategy is different for everyone, as you say. Everybody has a different scenario, and making sure that we use all the tools that we have available to us to say, okay, which one fits which strategy and which long term goal somebody wants to achieve.
Yeah, absolutely. Absolutely. Yeah. So that's and yeah, I mean, there's other programs out there too. There's rent to own programs. There's so many of them. And I think that's the other reason, like, when people are walking into a bank, and get it, like, mortgage brokers, we deal with the banks, like, it's BMO, TD, Scotia. We have those banks, right? And you got to understand that again, but we're not just limited to what that bank can offer. They don't have programs like this. They don't know, but, like, it's just not available within their channels, right? Um, so if anybody's gone to a bank to get their pre-approval, like, go get a second opinion. Go to a mortgage broker, right? And go to a good mortgage broker. Not every. I just had somebody. Like, I do a lot of social media stuff, and I have had a TikTok feed going out. Somebody responded to the TikTok feed. They said, "Listen, they needed their house was closing, and they sounded very sad when when they talked to me, right?" And I said, well, let me understand what you want to do. And I guess there was this program that, because I was talking about down payment assistance, full 20%, and their situation, for them taking over the house, they needed the 20%. And so they asked if they could use this program for it. And basically, we looked at it and said, yeah, we could, but I don't know if this is the best program with your situation. I want to see what other resources you have. And we found out, we had the parents, we could do something else to get them into a home. But she told me she went to 12 mortgage brokers and they all said no to her, right? 12,
Hmm.
right?
Hmm.
How does that happen? I don't get it, right? So So pick the right realtor, pick the right mortgage guy.
Well, I have to say, Lauren, the reason why I really like working with you is that you have that strategic focus. It's not about, one size fits all and you're like, okay, this everybody fits into the same block. You're looking at things holistically again and looking at strategies to really help the clients, achieve their goals. Because that's the most important thing, to help them to get in, because we know as time goes by, equity bills on average 7.7% over year on average. So, or sorry, 7% year over year. So it's important to make sure, to be a trusted guide, a trusted advisor for clients, to make sure, we're looking out for their best interest.
Yeah, it's what we do, right? And
Mm-hmm.
I think that at the end of the, like, we kind of come from the same camp about, the we're very grateful for the relationships that we have, right? And the
Mm-hmm.
trust,
Mm-hmm.
because they're trusting you to find them and help them navigate and negotiate and get them, into the proper home for them, and give them straightforward
Right.
advice. Tell them, based on where they are, make them see the things that they might not see, because it's very emotional when they're going through it, right?
Exactly.
And you're their guide, you're their Yoda to help them get to where they need to get to, right? And on my side, I'm responsible for them having one of the biggest debts they're ever going to have in their life. So my role here is to help them manage that debt throughout their life. Sorry, I don't want them to have it for their entire life.
No.
I want them to pay it off sooner, right?
Help
So
as
it's
soon
like, I
as
don't want to say,
possible.
man, I'm going to pay this till I'm like 90. No, I want to, because, people, it's like, talk about getting in the first home. And there's people that would, that I talk to, helping to buy their second or third home. And I think about where they were when they bought their first home. And they never thought they would ever be in a position to be buying their first investment property or their second investment property, because they just wanted to get into home number one. That was their dream, right? And that's the first thing, right? But the
Exactly.
magic can
First
happen
steps.
when you own real estate.
Yeah, definitely. Oh my goodness, yes. Magic definitely can happen. With that, I'm gonna end off with this quote. A funny thing happens in real estate. When it comes back up like gangbusters. And that's a quote from Barbara Corcoran of the Corcoran Group. You've probably seen her on Shark Tank. And I'm saying that because, yes, over the past the year or so, we've seen a lull. But it now is the time to, if you're thinking of purchasing, it might not be next week, next month, but if you are thinking of purchasing in the near future, now is the time to start preparing, understanding your financials, understanding what the process is, and understanding potentially what options you have in order to get yourself into that first home, or maybe you're going to be investing. Maybe you need to look into what options you have for investing.
Amazing.
So with that, Lorne, thank you so much for joining us today. We really appreciate it.
My pleasure. Anytime I'm invited, I'll be there.
Like what you hear? Follow this podcast today and leave a rating. I would like to take this opportunity to thank my producer, Stories and Strategies, for their amazing work. I have one last request. Please share this episode with one friend or family member. Thank you, and see you next time.